In this video, we are going to go over SolarEdge's stock as of April 2021, which includes the full financial year of 2020 for them. The data in this video comes directly from their 2020 annual report on Form 10-K. As for business, SolarEdge has two segments, Solar and All Other. Solar makes up a whopping 93% of total revenue compared to All Others at 7%. So it's a specialized company, which is good that they can focus on their niche. Their solar product is a photovoltaic system that is a direct current optimized inverter that they manufacture themselves. And what this device does is it is supposed to make solar panels more efficient and raise the return on investment for the solar panel owner. In case you're wondering, All Other is made up of critical power, energy storage, e-mobility, and automation machines. However, it's a really low percentage of total revenue at the moment, so their real cash cow is the solar industry. As for geography, most revenue is coming from countries other than the United States. United States only makes up 42% of their total revenue, and this makes sense since the company is an Israeli company. This is a good sign though, because there's still a lot of growth for this company to sell in the United States. For Auditor's report, the auditors had an unqualified opinion for both financial statements and internal controls, which means as far as they could tell, the company is fairly represented by the financial statements and internal controls are doing a good job for the company. In case you're wondering what unqualified means, this is the best opinion you can get. And the auditor was Cost for Gabe and Kaiser. I can't imagine a more Israeli sounding auditor firm than that, and they are a member of Ernst & Young. Okay, financial health. They have almost twice as many assets as liabilities, so overall their balance sheet looks good. Their current ratio is ridiculously high, almost at 4. Quick ratio is still ridiculously high when you subtract the inventory from the quick ratio numerator. Goodwill and intangible assets make up very little of the total assets on the balance sheet. This is a good sign when it comes to liquidity. It means almost everything is tangible and can be sold in case of a liquidation event occurs, which I don't see anytime soon with this company. About half as much debt as equity, which is great. You can see there at the 0.54 times. $17 of tangible book value per share is quite a lot. Of their sales, about 15% of it is made up of accounts receivable, which is pretty good considering that this firm does sell a lot to other businesses as a wholesaler, so that's pretty good collection of cash there. Both operating cash flow and EBIT are plenty to pay their interest expenses. You can see it's literally almost 700 times and 444 times. This is saying that their interest expense is most likely not going to bankrupt the company. And then finally, other assets over total assets, 5.78%. That's nice and low. Not a lot of hidden assets on their balance sheet. So as far as liquidity goes, this company is good for a long time. Here are some valuation metrics. This is where the problem is though. You're currently paying $131 for each dollar of free cash flow that SolarEdge makes. This is higher than the 3-year average of 87. Since price to free cash flow over free cash flow growth is negative, I made an adjusted one using a higher CAGR of around 9%. That was close to my average, but still a little optimistic. And even then, it only came down to 14.41. As a value investor, you would like to see this below 1 or at 1. So even the fast growth that this company is seeing does not justify the high price at the moment. That could change in the future, of course. And a lot of cash per share at $16.04. That's good for liquidity, but not what you want to see for a company because there's a lot of cash on that balance sheet that's not being put to use. And then the 3-year average for free cash flow per share is $2.80. For profitability, this is not quite as bad as valuation. It's still not phenomenal, but you can see low free cash flow to total assets and invested capital are rather low compared to any other industry, but this should rise as the company becomes more profitable and doesn't buy as many new assets. CapEx makes up a little over half of operating cash flow. That's not good, but like I said, hopefully all these assets that they're buying will be able to last a while before they have to buy new ones or upgrade them or repair them, so this should get better in the future as well. Gross margin is a little bit low compared to other industries at 31.62%, which means COGS are really beating the revenue a lot at around 70% of revenue. However, the EBIT, free cash flow, and profit margins are looking pretty good compared to other industries. So after they get through that COGS expense, they are a pretty profitable company. But I would really like to see that free cash flow over invested capital come up to around 10% or so. As for competitive advantage, we gave them a 6 out of 10. Just because this is such a new industry, a new market, it's tough to really compare them to their competitors. However, there was a study done by a large analyst in the inverter solar industry, and they did say that SolarEdge is the market leader when it comes to revenue. So far that's a good sign, but it's just too early for us to really say. But we did want to give it a 6 just because really what else are you going to judge a company on right now besides their market share when it comes to this solar industry? Growth rates. The 3 highest, as you can see on here, are free cash flow, available to equity investors, revenue, and gross income. The free cash flow available to equity investors is really high right now because they just took on a lot of convertible debt. So this could be turned into equity in the future, but right now they do have to pay some interest on it. The 3 lowest are net income, EBIT, and free cash flow. The free cash flow comes in at negative because the last year was a little bit lower due to the company buying so much inventory. So this would not hurt the net income, but this would hurt the free cash flow. So don't be too alarmed by a negative free cash flow CAGR. I chose free cash flow as the base amount to use for applying the optimistic and pessimistic CAGRs because it represents such a good cash flow available to equity investors. Free cash flow to equity investors is even better, but it is artificially inflated this year due to the company taking on a lot of debt in 2020. I chose 14.02% as the optimistic CAGR because that is what CAGR would be if they hadn't have increased inventory so much. So I went in and adjusted that number and found the CAGR for that number. Pessimistic of 5% is absolute worst case scenario unless some other global pandemic decides to happen. Like I said, they're the market leader. They seem to really specialize in this inverter and making the solar panels more optimal and efficient. When using these metrics, this created a range of $42.39 to $22.82. Using the average between the optimistic and pessimistic growth rates came to $31.04. To summarize our opinion on SolarEdge, it's a great, innovative, specialized company, but highly overvalued. It is selling for over $200 a share right now. That price is just too high, even when accounting for the growth in the company. If it ever corrects itself or goes to a lower value, we highly recommend buying it if it gets anywhere close to $31. But right now it's nowhere close. Thank you all for watching until the end. If you enjoyed the video, please like and subscribe. Please dislike the video if you didn't enjoy it so I know what type of content to make for you. Also, if you have any more recommendations for stocks you would like me to value, preferably in the renewable energy industry, please include that in the comments as well. Thank you for watching and go have fun investing.